Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Canadian Pacific Kansas City Railroad stock, ticker CP. This is the U.S. version of the ticker. I think it has the same ticker on the Toronto Exchange, and so there might be some differences in the numbers. Just worth noting at the beginning. As always, this is not individual investing advice. This is just how I analyze stocks. I think this is the last in the railroad stock series. I thought I had maybe wrapped it up, but somebody asked for this one yesterday. So to wrap up this kind of playlist for the railroad stocks, I'm going to go ahead and cover Kansas City Canadian Pacific combo. Okay, so let's start with the long-term earnings patterns that we see here. So generally speaking, pretty good. Let's move this to present day. And we'll get a read on the basic earnings growth, which is around 11% over this time. That does not include these drawdowns. That's just measuring from this point up to this point. Let's now go look at the historical earnings cyclicality. Okay, that's the dark green shaded area here. We don't need the normal PE. So the dark green shaded area, and then down here on the fast graph, you can see the annual drawdowns. So it peaked at 88 cents a share. It bottomed at 53 cents a share 2 years later. So we had 2 years when we were in recession that earnings growth declined. Definitely moderately cyclical, not quite deeply cyclical, but kind of getting close. Like 50% is the kind of rough threshold that I use. And it fell like 40% off its highs, just give or take, earnings wise. And then we had like a recovery year and then another kind of rough year. And then they started to grow again on an earnings per share basis. So quality business can get through a recession, but moderately cyclical as well. Now, analysts are pretty optimistic about earnings growth here. I'm not sure why, but I'm mostly going to ignore these for now. I am going to give them credit for this coming year's expected earnings, but only when I do the earnings earnings per share that they're likely to earn this year. For the earnings growth calculation, I'm going to use this time period here from 2016, like it's about 2015 or 2016 through the end of 2024. So again, on the fast graph, we don't have any real drawdown, a little bit of one there, but we don't have any real drawdowns here. The earnings growth rate is 8.18%, but we had a big transaction with Kansas City, the merger, or I think Canadian Pacific technically bottom. I don't know. I didn't look at it that closely. So it was kind of a merger acquisition type of a thing. So what I want to point out here is leading into that, you can see the jump in earnings per share here. So whenever they did the merger, they issued a bunch of new shares as part of that deal, and that increased the overall share count for Canadian Pacific. But leading into that, they had reduced share count by almost 20% in the previous 6 or 7 years. I think I calculated it at 7 years when I did it. So what that does is inflates the earnings per share growth that we see on the fast graph, this dark green shaded area. Also this number right here, which is what it's based on. Because it reduces the amount of shares that are outstanding, and that makes the earnings growth per share look better, like it's growing faster than really the real earnings really are, because they take some of their earnings and they buy back their shares. And when you do that enough, then it looks like your earnings are growing over time when you look at the per share basis, but they're not growing nearly as quickly as it appears. So I like to control for that. It gets a little trickier when they increase the shares during the buyback, but basically, or during the merger. But basically, I calculated it during this time leading up to the merger, the earnings growth. And then we can actually see the difference that not buying back the shares makes, right? So since 2022, the last 3 years, right? 2022, 23, 24, the last 3 years, they haven't bought back any shares. And if you look at the earnings growth during those years, it's flat. They earned actually 1 penny less than they earned in 2021 this past year. You can kind of see the difference that it makes. Now they probably have debt that they're paying off with that too. So there's extra from the merger. So it's not like a pure one-to-one thing, but you can see the difference that buying back 20% of the company with your extra money has when you stop doing it. Like the earnings growth basically just stopped. And we had inflation of, let's call it 13% inflation over the past 3 years. So actually this earnings growth in real terms is negative. But longer term, I think, they should be as good as any other railroad. Probably will be able to grow at some point, once we get through any kind of issues. People still need to move. Railroads are an efficient way to move a lot of goods. So whenever we get back to like a normal economy, I expect they'll have kind of historically similar type of returns. Okay, so when I adjust for that, right? So this earnings growth was 8% when I had it set up to the right. And after I adjust for that, I think the earnings growth rate went down to, about 5% here. So that's the difference between making the adjustments and not making the adjustments. So 5% earnings growth isn't great. Inflation during that time period was about 3% a year. So you're getting a couple percent each year in earnings growth, like real earnings growth. So that's not too bad. It's a growing business. There's plenty of businesses that don't grow and fail during this time. So, and you can kind of see why the merger sort of makes sense, right? Because there just isn't a lot of growth there to begin with. So the fewer railroads that there are, the more pricing power you're going to have and you're going to need it. So in terms of like the merger and stuff, I don't know the exact deals, but in theory, it's a good idea to consolidate a little bit more. So I don't have anything like negative to say about that. So let's do our calculation for time until payback here. So the idea for this is we want to know how long it would take if we bought the business to earn our money back from the business's earnings. So if you pay $100 for the business, how many years would it take to build up $100 in earnings from the business? I'm going to use these forward earnings here. So analysts are expecting earnings to grow 17%. Personally, I would not believe that, but they might. So I'm just going to use what analysts think, and I'm going to pull that forward. I'm also going to pull forward that 4.94% earnings growth. So that's a pretty big optimistic kind of beginning. Like, I don't think I'm being rough on these guys at all. I'm going to assume that they can grow earnings a lot this year. And then from there, I'm going to assume they grow at like that roughly 5% rate. And we'll see how long it takes us to earn our money back. So we have our earnings growth rate, which is what we need. We also need the earnings yield. So the way to think about the earnings yield is if you bought Canadian Pacific for $100, you would earn $3.63 in earnings, assuming there's no earnings growth. So each year you could earn $3.63 for every $100 that you spent on the company if you own the business. But I'm going to assume that this grows at 4.94% a year as well. And I'm going to pull forward that first year, like I said. So let's see what that calculation works out to. We start with our 363. We pull forward the earnings growth for the first year. And we are going to have $3.81 on our $100 investment the first year. We get to keep that. And the next year we earn $4. We get to keep that, and so on. So using that process, it would take about 18 years. Oh, I did make an adjustment for debt. I forgot to mention. I increased the stock price by 22%. Let's take a look. I think for this one, so the long-term debt to capital was actually 28%, but the difference between the market cap and total enterprise value was only about 22%. So I just used the 22% number. So I'm assuming you're buying the business and you're buying that 22% extra to cover the debt. So you would own the business close to debt free, probably. It's all just an estimate. Just so because some businesses have a lot of debt and they'll look cheap, and it's because they have a lot of debt. So it's good to just, try to include some of that, which is what I'm doing. So I'm treating the stock as though it's trading at $95 a share instead of $78 a share. So when we do that, it takes about 18 years. It'll take about 18 years for the company to earn their money back. So the average of the S&P 500 is about 15 years, which is expensive. 18 years is really expensive. That's a long time to wait to earn your money back on an investment. I want this to be at 10 years before I buy. Over 15 is probably a sell, unless there's some reason why, you expect earnings to grow really fast. Now, I think Union Pacific and CSX were 17 years, about the same, basically. So it's trading similarly to its peers. Norfolk Southern was 15 years, which is more in line with the S&P 500. So on a relative railroad basis, it looks better. Now, that said, if the market's correct about earnings growth growing like mid-teens, I'm guessing if I plucked in like 13% earnings growth, we might get down to 15 here. Yeah, so if they can grow earnings at 13%, now it's a 12-year time until payback. So a lot of it has to do with, what you expect the earnings growth can do. Let's see, actually, I was just using so they're looking at 17, 15, 13. Yeah, so I think these are probably super optimistic, honestly. But I thought I would show you that if you understand, obviously I cover so many stocks, I don't get into them super deeply. If you do deeper research and you find out, look, this is legitimate here, like this is a legitimate expectation that they're going to grow much faster than they've grown in the past. They have had periods where they grew that fast, 2017, 2018, 2019. Now I'm projecting out usually at least 10 years into the future. So I try to take into account the down years. Now, importantly, I did not take into account a drawdown in earnings like the Great Recession had. If you put in 2 years of 40% earnings growth declines, that's going to stretch out that number. It's going to lower the earnings growth rate even more. So definitely the market's not pricing in a recession at all. But like I said, if a person does their own research, they dig in and they think that this future earnings growth rate is strong, then you can justify the current valuation a little bit, more, definitely more. If they can really grow it, they're talking really an average of 15% the next 3 years. There's no way they can do that for 10 years. I feel unless we have a lot of inflation or something. So I always lean toward the conservative end especially when it comes to like a big established business. It's not like railroads are growth companies anymore. The best you can kind of hope for is GDP, type of like real GDP type growth. That's probably what most people should expect. And if they do better than that, that's wonderful. But over the long term, it's really hard to see how they do better than that, right? And I'm not expecting 12% GDP growth. So, all right, there you have it. I have like the whole series done now, and you can check those out. I'll put up a playlist. I'll probably do this with some more industries, but I had a specific request for this one. And, next time, if I ever come back and revisit the railroad stocks again, I'll add those to the playlist. Again, if you found this video useful, hit the like and subscribe button. I have weekly picks over on Patreon for $25 a month, as well as a free tier over on Patreon, where I post all these same videos. And I'm probably going to start posting some exclusive free videos on Patreon too, just to get some more free followers over there, so I'm not too dependent on the Google algorithm, to get me in front of everyone and to let people know when I'm putting out videos, which is pretty much every day now. Usually if I miss a day, I'll have a day with 2 videos. So we're pretty close to putting a video out every day, and I'm going to keep aiming for that going forward. All right. Thanks for watching. I'll see everybody later. Bye.